Hello and welcome to the Bank News Media webinar series. My name is Afton Rodriguez with Bank News Media, and it's my pleasure to host today's webinar, Decisions, What Do We Do Now?, sponsored by Country Club Bank's Asset Management Group. I would like to take a moment to thank you all for attending today's webinar. We will have a question and answer period at the end of the webinar, so please submit your questions using the question function on your screen when they arise. As a reminder, this webinar is being recorded and everyone registered will receive a link to access the recording at a later date. Today's webinar will discuss the importance of understanding the current market conditions and strategies that make the most sense given the shape of the yield curve. The strategies discussed will focus on pricing and purchasing decisions that will help maximize your profitability in any rate environment. Today's presenter is Erin Stouffer, Relationship Manager at Country Club Bank's Asset Management Group. Erin's background as a former examiner affords him a unique perspective on balance sheet management. He is responsible for providing advice on asset liability management, including interest rate risk, and overall balance sheet management and investment strategy. Now, please join me in welcoming Erin to the Bank News Media webinar series.
Thank you, Afton. Before I get started, do want to let everybody know I got this late spring or early spring, late winter cold, so I apologize if I'm coughing or sneezing on anyone. So, also, just to give a little bit of a background, and obviously I must point out our standard disclosures. Keep in mind this information is for institutional investors only. My agenda for today is to give you a brief introduction of myself and Country Club Bank, provide you some market commentary, discuss regression analysis and what it means and what to do with it, discuss balance sheet strategies given the current market, and then open it up for just questions at the end. So let's go ahead and get started. As Afton mentioned, my name is Erin Stouffer. I joined Country Club Bank in 2015 after spending time as a bank examiner, leaving there as a certified examiner in charge. While I was an examiner, I found myself spending more time assessing the asset liability function and trying to help bankers get more out of the reports and processes they were doing. Most of the time, these seemed really to be just checking the box type of items for a lot of banks, but for the few times I found banks fully utilizing the reports they were using, I found they shared a common trait. They tended to be better performing institutions and had a stronger understanding of their balance sheets. Now, many of you on this call know who Country Club Bank is, but for those of you that don't, we are a community bank that has a retail operation here in Kansas City. Byron Thompson bought a $45 million charter back in 1985 on the Country Club Plaza here in Kansas City, hence the name. Today, we're now over $1.4 billion in assets. Byron passed in 2015, but his legacy remains. We remain family owned by the Thompsons and provide many products and services to our institutional customers in addition to our retail base. Being a community bank ourselves really provides us a unique opportunity to truly understand the challenges our banking partners experience on an ongoing basis. So now, let's take a look at what's going on in the markets and why you guys are all here. We all know the Fed started the tightening monetary policy in December of 15. Since they started raising rates, they've moved the target a total of 9 times at 25 basis points each time. And in December of this last year, the Fed meeting, they adjusted their forecast for this year to 2 rate hikes versus the 3 to 4 that they predicted earlier in 2018. Now on March 20th, this last Fed meeting, they told us what many of us already were expecting, and that they took all rate hikes off the table for this year. They're also predicting 1 rate hike for 2020. However, the news that they did provide us, that gave many of us a better look into what they really think of the economy, is that they plan to stop their balance sheet roll-off in September and start reinvesting mostly in treasuries on the short end and amounts over $20 billion back into mortgage-backed securities. This little bit of information tells us that the Fed thinks there's more than just a pause in rate hikes needed to keep this economy moving at their targeted inflation rate, and perhaps some more stimulus, if you will. But that strategy also means that there's potential, if we remember Operation Twist, that we could see something of that nature at that point. When we take a look at the WIRP function in Bloomberg, this is just the probabilities of a Fed rate hike. We see that as of March 25th, there was a 0% probability in the rate hike between now and the end of January 2020. In fact, the probability of a rate cut is now nearing 75% in January. The other thing from this chart that I find interesting is that they've added a new column here. It's the forward rate there off to the right. And the current Fed effective rate at the top, if you see here, currently at 241, that's the current effective rate, overnight rate. But if you look at the projection, the forward rate is expected to drop down below the lower bound of our target. So this is a new column they've added onto this chart here. Now, again, this isn't what the Fed members think or told us. This is what the market is telling us of what they think of what the Fed's going to do. If we look at what the Fed is planning, we can see what each of the voting members think about the implied forward Fed funds target rate. And we see that here in 2019, get this. So here's your 2019. We have 11 Fed members expecting no rate change this year, and there's 6 that expect a rate hike. And in 2020, the number that think that rates aren't going higher falls down to 8, saying there's no change in order, with 10 members expecting at least one rate hike in 2020. What we don't see here in this dot plot is that any member expecting a rate cut at this time, and there was even talk from Fed Chairman Powell at the last Fed meeting of doing away with this dot plot because it really hasn't been a very accurate outlook of the target rate anyway. But if they do continue using the dot plot, I expect to see somebody down here with at least one rate cut here either in 2019, if not at least in 2020. Okay, so what's happened to the Treasury market over the time that the Fed has been raising rates? Well, the 3-month Treasury, if we look at 2015, moved from a mere 16 basis points at the end of 15 to 2.46% as of March 21st. That's a change of 230 basis points. The 2-year Treasury has gone from a 1.05% to 2.4%, changing 135 basis points. The 5-year has moved up 57 basis points. The 10-year has moved 25 basis points. However, what you don't see here is that the high in the 5-year and the 10-year Treasury, really all points on the curve, was set back in November, on November 8th. The 5-year was a 309 and the 10-year was a 324. So they're, from the 10-year, from a 2.27 to a 324, almost 100 basis point increase at that point. Now, if you look at the spread, since the Fed started moving rates up in 2015, the spread between the 2-year and the 10-year Treasuries tightened from 122 basis points down to just a mere 12 basis points. And the spread between the 3-month Treasury and the 10-year Treasury, again, this is as of the 21st, was 6 basis points. Of course, that was at the time I put this information together. And if any of you have been keeping an eye on the market, we are now inverted between the 3-month and the 10-year. And I'll talk a little bit more about that spread here in a minute. So sometimes pictures are a little easier to see than chart of numbers. This graph represents those same data points in that previous chart. This light blue line is the 2015 curve. This darker blue line is the current curve as of March 21st. And what you see is the 3-month Treasury higher than the 5-year and basically on par with the 10-year. We do have inversion now, and essentially completely flat from the 3-month to the 10-year. Again, March 21st. Now we are just downward sloping going forward. Oh, let me go back one. Well, I am missing a slide. There is a slide that is missing in this presentation. I'm not sure what happened to it. But where do we go from here? Well, we don't know necessarily what the curve is going to be between now and the end of 2019. If we look at what the Fed funds rate expected forward is, the Fed is expecting that to come down, or at least the WIRP. And with the effective forward curve, we were seeing about a 2.1 on the Fed fund rate, in January. If we look at what's going on between the 10-year and the 5-year, and the next graph here will actually show you some of the trends that are happening. But really, there's no one out there telling us what they expect the curve to be. Is that there is going to be some volatility, and with what the Fed is planning on doing later this year, then that's going to have a big impact in what actually is going to happen with that curve. But my guess or my prediction is that in the 10-year, I think we're going to stay in this range that we're in. And right now, again, we're at a 237. I don't see it moving up a whole lot, but I do see the short end coming down with what the Fed's planning on doing. So as we take a look at this graph, we see here that the spread between the 3-month Treasury and the 10-year Treasury, which is the blue line, the shaded bars here, the last 3 recessions, the black line would be your 5-year Treasury. And there's a few points about this graph that I think provide some interesting color. First, the spread between the 3-month Treasury and the 10-month Treasury, or the 10-year Treasury, is a better indicator of a recession than the 2-year versus the 10-year that's often followed in the financial market. And there was if you read our daily PMRs, we wrote an article about why we think that the San Francisco Fed came out and pointed to that's what they look at as a better indicator of predicting a recession than the 2-year to 10-year. Earlier this week, as I mentioned before, the spread between the 3-month and the 10-year turned negative. And we continue to be inverted here. With the 3-month today was a 243. The 10-year was at a 237. So we've got about 6 basis points of inversion. And if we look at this graph and focus on this blue line, the thing that I'm looking at, when we see it go negative right before the recession, and all 3 of these points, we do see a short-term correction or widening of the spread, and then it goes back down again. So if you look at the far right, we're right at that point, and there's if history has a way of repeating itself, there's a chance here that we're going to see a little bit of a correction, and then it'll invert again before it comes out of that inversion. Excuse me. The other thing that I see here is if we look at the 5-year Treasury along this point here, we can see that the 5-year Treasury peaks often right before that inversion. So here in 2000, we saw a peak, the curve inverted, and the 5-year Treasury has just steadily come down. Again, back in 2007, we saw the inversion, 5 years peaked, and we've come down. The point that I'm making here is if we look at where we are, we've got inversion, 5-year back in November peaked at a 309. The likelihood, or what we're looking at, is that the 5-year is going to continue to come down. We're going to see probably short-term corrections, but until we see a shift, my guess is that the high water mark in the 5-year is definitely in our rearview mirror. So if we're waiting for 5 years Treasury to return to 3%, we might be waiting a while. Now, one thing to keep in mind here, this chart doesn't tell us that we're currently in a recession. However, it's definitely starting to indicate that one might be coming into view. As we take a look at some of the key economic indicators, we see GDP was 2.9% for the year, and that was in 2018, and 2.6% just for the fourth quarter of last year. Now, the Fed is expecting GDP for 2019 to be at 2.1%, and that came from their minutes that they released at the last meeting. Now, CPI is down slightly from January, running at 1.5% year over year. And my thought really is a manufacturing index is a number that we really need to keep a close eye on. Anything over 50 is said to be expansionary, and in February it came in at 54.2% or 54.2. While this is down from January, we're still above 50, so we're still in expansion and not contraction as far as this metric is concerned. Of course, the unemployment and underemployment rates are still very strong, with unemployment at 3.8% and underemployment at 7.3%. Another piece of information to look at is the Coincident Economic Activity Index. This index includes 4 different indicators. Each state has their own, but this one is for the U.S. in aggregate. This is non-farm payroll employment, the unemployment rate, average hours worked in manufacturing, and wages and salaries. And as you can see from this chart toward the end here, we are still upward sloping. We're not seeing a top at least yet. There's no sign of that rolling over. So again, upward sloping here. In conjunction with the Coincident Index, the leading index for the U.S. predicts the 6-month growth rate of the Coincident Index. So this is saying, okay, what's the expectation of the growth of that previous chart? And this is telling us we still have a bit of economic growth expected, but it does seem to be coming in, as you can see here. See a little bit of a downturn there. And typically, though, this chart does point to the fact that the number doesn't just gradually go into a recession. If you look at these points right before recession, we see sharp falls leading into that number. So the change before a session is really sharp, and if you wait until that happens, usually it's a little too late to modify any strategies, as you'll be doing pretty good just to keep up. The great unemployment, underemployment numbers mean that we're seeing some pretty good economic times. But we do see this number tend to coincide with peak economic conditions just before change. It does appear that we are seeing a little bit of a trough or a bottom in this. And again, prior to recession, that we do see this number to bottom out. So what is all this market information telling us? Well, the Fed has signaled a shift in their policy from the gradual rate hike policy to now needing to do something to stimulate the economy via the ceasing of the balance sheet reduction that they mentioned for later this year. When we look at some of the key market indicators, they still show positive signs, but the outlook is not as positive as before. The yield curve is inverted, indicating that the peak has happened in this economic cycle. Treasury rates have already started falling off from their highs in November, and we know we're not currently in a recession, and I repeat, we're not in a recession yet. However, it does seem that many of the indicators are pointing to one might be looming. So now that we know what's happening in the markets, how do we use this information to look forward? After all, the bets you make about your rate outlook are what you are measured against. Many of us have finalized our 2019 budgets earlier this year, and I've not seen many banks' budgets showing a decrease in rates in their projections. We're already closing in on almost 100 basis points off the 5-year Treasury high we hit in November, which oftentimes is when your budgets were, your rate outlooks were being formulated. So what can we use to determine or develop a rate bias? We can use what happened in the most recent 12 months and apply it to the next 12 months, which this is what we call a recency bias. So doing what we've already done or what's just happened. If we're in the middle of a rate cycle, this approach could work, but if the cycle shifts, then we could see large variances in the outcomes in our balance sheet. We can use whatever the Fed says. If you utilize the Fed's talking points in December's meeting, you're anticipating 1 or 2 rate hikes this year. And now they've changed that here at the beginning of the year. You may have a favorite economist that you follow, but at any given point, there are economists supporting both sides of any outlook. So, hoping that the economist you follow is on the side of where the market's going. I mean, you can ignore all the talking points and put together your own technical analysis for your future outlook. Assuming you have the time and resources, this method could work pretty well. But sometimes we tell ourselves that this time is different, and even when all indications say otherwise. We can also use a statistical approach. I'll spend a little time showing you how you can do this. And while a statistical approach isn't perfect, utilizing multiple techniques to provide a rate bias will help you and help provide some confidence in executing a balance sheet strategy effectively. So how can we use statistics to predict rates? Well, we can use a regression analysis. You may remember this from your statistics courses in college. It's a measurement of probable outcomes. The idea as it relates to the market is that prices or yields will tend to revert to their statistical mean or average. This mean could be based on any look-back period. The further away from the current point you are away from that average, the higher the probability that the price or yield will move back to that average. The issue with regression, or one of its faults, is that it doesn't tell us when a change is going to happen. It's just telling us that it's probable to happen. And depending on how you want to utilize it, you can look at the regression over different time intervals to get a sense of where you are in relation in that current cycle. So we oftentimes internally look at a 1-year regression to know where we are in the current rate cycle. For instance, if you're looking at, not that we want to time the market, but knowing if the market's overbought or oversold. And then we also like to look at a 10-year regression, which gives us more of a overall balance sheet strategy if we're trying to plan more long-term in where rates are likely to go. So if we look at a 1-year regression of the different tenors of the Treasury curve, we can see here in this chart, the 2-year Treasury and the 5-year Treasury points are below their 1-year statistical average or mean. So you can see here on the right, this gray line is the mean or average. The dotted green line would be 1 standard deviation, the blue line 2 standard deviations, and the red line would be a 3 standard deviation. So we're just looking back over a 1-year time horizon and looking at where we are in relation to the current market. You can see here in November, we were touching or really close to touching a +2 standard deviation, and you've noticed that the rates have come down from there, both in the 2-year and the 5-year. As we take a look at the 1-year regression for the 10 and the 30-year, these two are below the 1-year average. When you take a look at the regression, the distance away from the average determines the probable chance or probability that the move does happen. At 1 standard deviation, there is 66.5% probability that the mean or the point will revert back to that mean. At a 2 standard deviation, we're at a 96.4%, and at 3 standard deviations, we have a 99.5% probability or chance that point is going to move back toward the mean. And so, again, kind of looking at this November point, you see we hit 2 in the 30-year and plus 2 in the 10-year, and we've come down, we've hit, and now we're back below the average. If we take a look at a longer time frame, for example, here's the 10-year regression of those points. You can see the same thing. You can see back in 2009, we were at plus 2 standard deviations away from the mean, and it took about 18 months to get back to the mean. Also, you can see in the 2-year regression, we stayed at this minus 1 standard deviations for about 5 years. This tells us that when we're just 1 standard deviation above or below the mean, we need a little bit more information in our decision-making process. 66% probability is, while it's more than 50%, it's still not a huge probable move. But when we do hit a plus or minus 2 standard deviation, you can see that we do get back to the mean and oftentimes go back through it. So if we look at that previous slide of the 2-year and the 5-year, and we look at this one, the current point is that we're still above the mean. We're 1 standard deviation above the mean, and if you look, we hit 2 standard deviations, so the likelihood of reversion is still pretty great. If we use this point of plus 2 standard deviations above the mean in conjunction to where we currently are, the likelihood of that going down and hitting that mean is still more probable than the rates going back the other direction. So what do we do with this information? What decisions do we make in our balance sheets with this? If we look at plus 2 standard deviations and an inverted yield curve, which is where we currently are, we can see on the liability side of the balance sheet, you can see we want to be shorting as much as possible. If you're putting out rate specials, those should be offered as short as you can. Also, now's not the time to be extending any of your liabilities unless you've got a way out of that position without large fees. On the asset side of the balance sheet, you should be looking at just the opposite. You should be extending those durations. This means favoring fixed rate loans over variable, extending your investment durations, and minimize your optionality in the investment portfolio. Additionally, now is the time to be tightening your credit standards, and I can't stress this enough, and not reach on credits or having loan policy exceptions. Late in the cycle, and given the inverted yield curve, this means that we have peaked in this economic cycle. But I know it's very difficult to do this in this market. As we've talked earlier, again, mentioned we are at the peak, and everybody looks really good on paper when they come in for a loan right now. So it's challenging not to be very diligent in that process. If you have any off-balance sheet swap activity, you should be looking at swapping out variable rates in favor of fixed rates on the asset side, and just the opposite on the liability side. So you want to receive variable on the liability side and swap out fixed, only if you're doing any swap business. As far as where you are with your max leverage, you should be favoring more in the investment portfolio and lowering your leverage exposure to loans. This is primarily because of your credit exposure. While you may be able to get a bit of a bigger yield compared to a bond right now, you're taking on credit risk in a loan that you don't have in the investment portfolio, assuming that you're staying away from private label type of investments. When we look at the strategies where there appears to be the greatest probability of a change in the rate cycle, we see some distinct differences. Also, there are times that, these are the times that are most difficult to make those changes, as we tend to get stuck with a recency bias at these points. Again, if rates are headed higher and or they're high, we think they're going to continue to go higher, or if they're lower, we're going to think they're going to continue to go lower. When the current position is at 2 standard deviations below the mean and we have a steep yield curve, just know that this curve outcome will likely flatten because the short rates are going to start coming up. The Fed is, if they see a steep yield curve, the Fed's initiative is to keep inflation in check, which is why the long end is up. And so they're going to start raising those short rates. In this case, you'd want to go long on liabilities and stay short on assets. And remember, the cycle after inverted yield curve is a bull steepening yield curve. However, bull steepening is the product of a decrease in the shorter end of the curve versus the increase in the longer end of the curve. Just because we start seeing steepening doesn't mean we are in the -2 standard deviation range. If you want an easy way to stay current on what's happening in the markets and where we are in the regression analysis, we do send out that regression curve every week via our email distribution, and I'll provide my email at the end of this presentation. You can let me know if you want to get on that if you're not already. So, what have banks done while the Fed has been increasing rates? I've got a couple slides here for banks between 1 and 3 billion, and a couple slides for banks that are between the 300 million and $1 billion. So I'm gonna hit on both segments, but I think that there's some differences between the two. Excuse me. So for the 1 to 3 billion, the cost of funds have increased 40 basis points, while the target rate has increased 225 basis points. Deposits grew about 0.5% of average assets. Core deposits have fallen slightly, with more deposits coming in the brokered market and the jumbo deposits. Also, borrowings have increased as a percent of average assets. All of this information is coming from the UBPR peer group analysis. Loans, as we've all experienced, have seen a drastic increase with 5% of average asset increase since the end of 2015. Additionally, the investment portfolios have fallen over 3% of average assets. So a lot of you have been funding your loan growth a lot with the roll-off of your investment portfolio and looking at either borrowings or wholesale type of funding, at least in the $1 billion to $3 billion range of banks. Now, the move from your investments to your loans has helped your ROA in this time frame, and it's improved about 24 basis points on average. And in a rising rate environment, we tend to see earnings increase, obviously, and this increase tends to come from making more loans and not seeing any of those loans have any deterioration. So you see that the non-accruals really came down a little bit, but not a lot of change. Now, for banks that are between 300 million and $1 billion, as many of you on this call might be, cost of funds for you have increased 31 basis points over this time frame. So you've been able to keep that down a little bit, although you started a little bit higher than the larger community banks. Deposits have grown slightly, with most of that growth coming from jumbo deposits, and your borrowings have fallen. So if you remember looking at the $1 billion to $3 billion, they saw broker deposits increase and borrowings increase, whereas the smaller bank sees a slight growth in their core and their jumbo deposits, but they're seeing a decrease as a total of average assets in brokered amounts and borrowings. Now, part of that could be that you might be using quick rate or something like that may get categorized as core. I didn't go that far in to see if that's truly the case. The loans have grown about 3.5% of average assets, and bad loans have fallen as well. Most of this loan growth, as we expected, has been funded with the investment portfolio, with that falling just over 2% of your average assets. Additionally, the increase in the loan portfolio also has helped your ROA increase from a 104 to 122 basis points. Now, I went back and I looked at the last the Fed rate cycle, when they were moving rates from their highs down to their lows. So that was from June of 2006 through December 2008. Over that time frame, they cut rates 10 times for a total of 500 basis points of cut. And in that last time, they cut it from it was about a 75 to 100 basis point cut based on the range that they fell to. The average cost of funds for all banks in the $1 billion to $3 billion decreased only 30 basis points over this time frame when rates were cut 500. So if we think about that from your betas and whatnot, really not a lot of movement in your cost side. And your total deposits fell just slightly to average assets. Core deposits fell quite a bit. From 57 to 54. This points to the fact that inside your core deposit base, there perhaps were a lot of people that saw some financial stress, and they used those funds just to kind of support themselves. I mean, that was a pretty bad time frame there. Insured broker deposits grew from 2.88% to 5.25%. This is most likely due to that decrease in the core. And needing to continue to fund the balance sheet, needed to have deposits or funding somewhere. Jumbo CDs also fell over this time frame, and we also saw borrowings grow. So, in this down rate cycle, saw a reliance on wholesale grow quite a bit. Loans grew during this time frame, which to me was a little shocking. That there was this amount of growth, and I think perhaps it grew because of just the change in cycle. The banks were still lending into this rate cut. Then if we look at after 2008, between 2008 and 2015, we probably see a little bit different trend in that time frame. Now, bad loans also started growing as we knew and expected. They grew from 0.48 to 2.5, and the investment portfolio actually fell over this time frame as well. And this is where you saw dollars still going into those loans during that time when rates were going down. But we did see gains come back, and many of you probably are seeing some gains come back in your current portfolios since the end of the year. In fact, I've heard about a couple cases where there was significant multi-million-dollar unrealized loss to now a slight gain in portfolios just over the last 3 months. The big number here, ROA fell from a 133 to a 0.18. So this is primarily impacted to the bad loans or the loans that started going bad. So the losses really started piling up and impacting earnings more so than what good loans do in the good times. If we look at the same information for banks that are a little smaller, 300 million to $1 billion, we see the same thing on the cost of funds. From a 313 basis point cost of funds down to a 294. So really not a whole lot of change here for a 500 basis point rate movement. Deposits also fell slightly. Again, coming from the core deposits, this was a time when the smaller banks started relying a little bit more on broker deposits, started getting into that market. Jumbo CDs fell as well, and borrowings grew and more than double. They grew almost 300 basis points of average assets. Also during this time, you saw loans growing as well as bad loans growing. And the investment portfolio also shrunk here during this time frame too. And the smaller banks were able to hedge a little bit better. Their ROAs only fell from a 128 down to a 0.53%. So as we've gone on this, and really I'm gonna stop here and wrap up and bring this to a conclusion. So what we know is that the Fed is officially on pause. They started the pause in January with their comments. From their most recent meeting, their pause now includes a defined action of ceasing the balance sheet reduction program. Their overall outlook from the dot plot is the next rate movement will be an increase in 2020. However, the market completely rejects that idea and believe they will be forced to cut rates with their next move. We're not currently in a recession, but there are many indicators pointing to the one is looming. Having a disciplined approach to managing your balance sheet is very tough. Our human instinct makes it difficult to change a strategy when the market indicates that you should, and oftentimes we wait until it's already too late. If we are seeing a lot of loan demand, it's difficult to stop lending and move more into investments. It's also difficult to tighten your credit standards in the midst of that high loan demand. Utilizing a disciplined approach like what you could with a regression analysis helps you make sound decisions regarding your balance sheet. Your asset strategies and liability strategies should complement each other in the cycle that we're currently in to help maximize your bottom line. Our current thoughts on the liability side of the balance sheet is that you should be shortening your liabilities right now. This is done, again, as I mentioned, with short deposit specials. If you're trying to still increase your deposit base, as many of us are, and issuing callable brokered CDs or short-term brokered or very short borrowings versus taking out longer-term advances or longer-term non-callable brokereds are preferred. So make sure that if you do go out long, that you've got an option to get out of that on the liability side. On the asset side of the balance sheet, you really need to be tightening your credit standards and look at lengthening your durations. This doesn't necessarily mean going out and making longer-term loans than you normally would, but you should prefer a fixed-rate loan over a variable-rate loan. Also, make sure you include loan prepayment penalties on fixed-rate loans, as this time is typically an easier time to get those on or in those contracts. But if you do require a variable-rate loan and you don't want to put on fixed-rate loans, you should prefer a 5-1 or a 7-1 structure, some structure other than just a current repricing or repriceable loan. And also on variable rate loans, you should make sure you review your floors and make sure that they're applied to those loans. As far as the investment portfolio, you should look at increasing your duration to create a bridge of income over a trough in rates. This is also the time to limit any optionality in your bond portfolio and be very wary of story bonds. This is when we start seeing them come out. These are bonds that have to come with a story to convince you to buy them. These oftentimes show wider spreads and bigger yields, but oftentimes are the bonds that don't have a very deep market and underperformed in a stress market. You should prefer bullet structures, callable bonds with long call protection periods, or callable bonds offered at larger discounts. Also stick to high quality bonds, whether it is in making sure you're buying rated municipals or agency or treasury backed bonds. So with that, and before I open it up for questions, if you'd like to hear more about our thoughts, we do write a daily email. These are generally short comments about the market and what we're seeing. And also, we send out that regression analysis every week on the first day of the week. So just send me an email, and I'll get you added to that list. So with that, I am happy to take a few questions if we've got some time.
All right. Thank you so much, Erin. We did have one question come through today. Has the inversion of the 3-month to 10-year spread always been a precursor to a recession, or has there been exceptions?
Well, with what we've looked at, I'm not sure that we've seen an exception to that. Again, with that chart that I showed, and if I can get back, you can see it at the last three recessions. That has been the case, but there have been times where we've seen a twos to tens inversion without a recession. So, but I can follow up on that with whomever asked that.
Okay, thank you so much, Erin. And thank you all again for attending today's webinar. As I stated earlier, we will be sending you guys a recording of the webinar for you to review if you would like. If anybody would like a copy of the slide deck to go over the graphs again, please feel free to email myself, or you can reach out to Erin and we can provide you a copy of that as well. Thank you again, Erin, and thank you everybody who attends today's webinar. We hope you enjoy the rest of your day.
Thank you.